the next presentation on the new fuel oil pricing landscape by Eugene Lindell from JBC Energy. Eugene has been with JBC Energy for well over a decade and headed both the downstream and upstream research teams at different points in his career. He's currently taking a more active role in consulting and business development. JBC Energy is one of the world's leading independent oil and gas market research centers, providing clients with analytical reports and market studies and data. Mr. Lindell has been using his vast knowledge of energy markets to advise national and international oil and gas companies, as well as government-related agencies around the world for many years. He is a crude oil pricing expert and for many years supported some of the world's largest oil producers in setting their monthly selling prices. He is also the lead editor and writer of JBC's Energy Bottom of the Barrel publication that focuses on dirty products and bunker fuels. Apart from his research and consulting work at JBC Energy, Mr. Lindell is a regular trainer at JBC Energy Academy, passing on his insights in the oil markets to the company's many clients. He also taught an oil-related course at South Korea's Ulsan National Institute of Science and Technology. On a daily basis, Mr. Lindell contributes to nearly all of JBC Energy's reports and uses his extensive knowledge of the energy industry to guide both seasoned and junior analysts alike. Prior to his work at JBC Energy, Mr. Lindell spent several years working in an intelligence cell at NATO regional headquarters in Brunsum, the Netherlands. So Eugene, well, the floor is yours.
Okay, well, thank you so much for the introduction, Patrick. It's great to be back again, though I would like to be there more in Rotterdam right now as in years past, but maybe next year. Yeah, so without further ado, I want to talk today about basically the new fuel oil pricing landscape. And whereas in 2019, everybody was talking about IMO 2020, then IMO 2020 came, and in 2020, everybody was talking about COVID-19. I know this is, some people may have heard that joke before, but it is quite clear. And now that we're finally in 2021, what we're trying to do is figure out which of the impacts we're seeing on price are kind of, one-off issues that are related to the impact and reaction of the refining system from COVID, and which are ones that we can expect further. Yeah, so let me just get to my agenda here. Yeah, so we'll be covering basically how COVID-19 impacted the market for fuel oil, specifically how the refineries reacted, what that did to availability and price in both for HSFO and for very low sulfur fuel oil, for VLSFO. And of course, we'll be looking at an outlook, particularly also for refining. I think that's an area where I think everybody here will be interested in hearing our views basically on the state of the refining system and the upcoming consolidations. We've heard about that a little bit yesterday as well. Yeah, and we'll also talk about fuel oil spreads as well. So I'd like to start just with an overview about fuel oil itself. So what we're doing here is we're taking global fuel oil and we're splitting it into the sector demand. And so as you can see on the left half there, we're currently around below 7 million barrels per day of fuel oil in the world. And more than half of that is in the black sector there, which is the bunker industry. And the rest, so red is industry, blue is power, and yellow is refining fuel. Those three are basically the same thing in a way, because it's all about burning the fuel oil in order to keep the lights on and power your refinery and your industry. So in reality, the use of fuel oil as a power generation fuel is, of course, it's very dirty. So it's something that has been irksome for some years and has been being reduced significantly as, for instance, more natural gas is being used. We had a massive project in, not only in developed countries, but now, for instance, in Egypt, Siemens had this massive combined cycle gas turbines that they brought on stream, and that basically turned Egypt into from an importer of fuel oil into an exporter. So there's, that sector has basically been under attack for some time. But as you can see on the right, so you see the steady declines basically in the blue and the red, so in industry and in power gen. But on the black bars tend to still be growing, and that's, of course, the bunker demand. But now that we are increasingly now talking about getting shipping to a much cleaner, less carbon-intensive emission pathway, now also increasingly that side of the equation will also be under attack. Yeah. So despite all of these headwinds, if we look at the refinery cracks for the different products. So what's a crack? It's basically just the value of the product less the value of the crude, so the input. And you can see that the black line there is fuel oil, and the fuel oil cracks over 2020 were actually above their 5-year average. So fuel oil, high sulfur fuel oil, was having the time of its life in 2020, while all the other products were having a really terrible time, particularly the yellow line, jet kero. Obviously, nobody was flying during the pandemic, and gasoline and diesel were impacted by the less driving. And yet you had a situation where, fuel oil was doing extremely well. And so now that is starting to unwind. You can see at the end in 2021, you can see how that black line has now come and reached parity to the 5-year average. So the question, of course, is then, is it going to continue falling and fall back to the levels seen in 2019, just before IMO came in, or is it going to stabilize? And that's kind of what I want to talk about today. But first of all, how did we get there? So we had, of course, the situation where the demand for transport fuels disappeared, and as a result of the lockdowns, we didn't need the fuel, so refineries stopped producing a lot of fuel, which meant that crude intake fell considerably by over 10 million barrels per day, as you can see here, and it's slowly been coming back. But currently, it's actually still very much, very far beneath where it would normally be. Now, that's had a tremendous impact on the products that are available out there, because when you run your crude intake lower, straight run products such as residue, such as fuel oil, the supply of those tend to disappear. And this is a major reason why fuel oil was so strong last year. And so the assumption would be that as refining capacity rebounds, like we show in our forecast, then at least some of that pressure should disappear. Now, before we think then that as that pressure disappears, supplies of high sulfur fuel oil will increase, and that in turn will decrease the price of HSFO, it's not that simple. Because we also have the situation that when the refineries stopped taking in crude, stopped processing crude, the suppliers stopped supplying crude. And most of the guys that stopped supplying crude were the OPEC Plus players. So chief among them, Saudi Arabia, but also Russia, and also Kuwait and Iraq and other guys. They all got together and they cut crude. But the issue is that they have the Middle Eastern crude barrel is very, is quite heavy and medium and heavy from an API perspective, which means that when you process that barrel, it tends to give you a higher fuel oil yield, which means when you're taking off this much of this very fuel oil rich crude, then you also get a lot less fuel oil residue in the global pool. And so that's what we've been showing here. And in fact, last year, as you can see, if you look in May, and you've got the big cuts then relative to April. So that was basically Saudi Arabia and the OPEC Plus guys. But even before that, if you go back to 2019, you can see that there was already a lot less residue in the global system. And this is because countries such as Venezuela, which has incredibly heavy sour crude, and that crude is incredibly rich in HSFO. The supply of that has crumbled, and we cannot really expect that to come back anytime soon. So that's still offline and will remain offline at least in 2021 and probably in 2022 as well. So you have a situation where, yes, you're bringing back the OPEC barrels. I mean, as we can see now, they're not all coming back. So Saudi Arabia has decided to continue to keep its volumes offline also in April. And so it's a slow return. Refiners are very keen not to overbalance the system. And so there's an issue going on there, basically. And so we would say that, yes, residue supply is coming back. But if you look at that relative to, say, 2018, it's still going to be quite tight. So that would speak in favor, actually, of even as we get more fuel oil in supply because of higher crude intake, the crude you're running is still relatively low residue supply crude. So that basically balances that out a little bit. So putting it all together, then what we have here is relative to our January 2020 outlook. So basically what we're showing is how our outlook changed relative to January 2020. And you can see that we had to cut HSFO, or we'll basically cut fuel oil supplies by 800,000 barrels per day in the summer of last year. And now it's gradually coming back. But as you can see throughout 2021, it is still below the January 2020 level. So yes, there will be more supply available compared to last year, but it's still not normal. So it's still going to be tighter than usual. Now, this, of course, has a big impact on scrubber spreads, on fuel oil spreads. So if HSFO is worth a lot of money because there's not so much supply of it available, it means that the premium of low sulfur fuel over high sulfur fuel is very, very narrow. So this is what's called the so-called high 5 spread. So the spread of high sulfur fuel oil over 0.5, otherwise known as VLSFO. So that high 5 spread throughout 2020 was kind of a low 5 spread, in the sense that it started out really, really, really wide, and that was great news. If you look on the right, it started out over $300 a ton. But then as HSFO got expensive and VLSFO got cheap, for reasons which we'll see in the next two slides, you had a situation where the spread was getting hit from both sides, strong HSFO and weak VLSFO. And that really made life difficult for those shippers and for those players that had expected a very wide spread. So some traders also got burned on that one. Now, VLSFO was also weak because it's a premium product. So it is actually trading at a premium to crude on a barrel basis. So if your margins are extremely weak, then refiners have an incentive to produce it. But also, and this is key, it got easier to produce VLSFO because refiners needed to do something with all of the jet and gas oil that they could no longer put into transport fuels. So this meant that you're processing the crude, but you cannot sell as much diesel and gasoline, and jet kerosene. So what do you do with that fuel? So they tried to blend the jet fuel into the gas oil pool, but then you end up oversupplying the gas oil side. You can put some jet kero into the naphtha pool. They maxed that option out, but you can also put some gas oil components, as well as even a little bit of jet kero, into the VLSFO pool. So what happened is that a lot of these components, normally more expensive components, ended up in the VLSFO pool. And so there was a big optionality among the refining industry that all of a sudden you could supply VLSFO a different way. And you saw this in the impact of the actual quality of the fuel. So the fuels, when they're more residue-based, they tend to have a higher viscosity. And when they're more distillate-based, and there's more gas oil components in there, they tend to have a lower viscosity. And we had situations where the viscosity was at the minimum permissible levels. So that shows that there was a lot of other components in there. We tried to model this, and we came up with a way in order to show how much non-residue is actually in the residue pool. So when you bunker HSFO or when you buy VLSFO, it is classed as fuel oil, but the thing is there are components in there, of course, which are not fuel oil, which are from, as I just said, from the gas oil pool, from the Caro pool, blend stocks in there to get rid of the viscosity, to blend it down or to raise the viscosity. There's all kinds of stuff in there. There's also, in the residue pool, there's also asphalt and other products. And so what we tried to do here is come up with a way to show how much additional non-residue is in the residue pool. And you can see that really increased strongly from basically from April, May of last year. We did that by calculating the API gravity of the global crude slate, because once you have that, you can find out what the residue supply is, but then you need to factor in how much of that residue is being converted in complex refineries. And then you take that number and you would then subtract it basically from the reported fuel oil supply, being that the reported fuel oil supply contains all kinds of other components. And so the residual is what you see on the chart. And you can see that there's basically, long story short, there's like an extra 1 million barrels per day and almost 2 million barrels per day of non-fuel oil components kicking about in the fuel oil pool. So that's, yeah. The thing is, once gas oil components get more expensive again, when demand comes back, then these the gas oil components are going to come out of the pool and get blended into the more expensive transport fuel segment. So that's something that would speak then in 2021 for a stronger VLSFO crack. Yeah. So on the demand side, we talked a lot about supply, but on the demand side, you also had a situation where global bunker transportation, so ship transportation, held up actually pretty well. Globally, we would say it only fell year on year in 2020 by about 5%, which is, far behind the 20 and 30% we've seen in other sectors. And at the same time, you have a situation where, because more and more ships with scrubbers installed hit the water, enter the fleet, you have a situation where the demand for HSFO specifically is increasing, and that is taking away demand from the VLSFO segment. So, and that's something that, a good portion of the new ships entering the global fleet have scrubbers attached. And that means that as we go on, we basically will, the share of HSFO will grow and the share of VLSFO in the bunker pool will decline. So that's something that would argue for narrower spreads. So as you can see, we have all kinds of stuff going on to answer this question. And so that's essentially what I showed. So we expect basically over the year, we expect on average about 120,000 barrels per day of additional HSFO demand coming in 2021. Yeah, and at the same time, you have a situation where refiners have grown very adept at using HSFO, not as a refinery fuel to keep the lights on, but rather as a process feed. So they're actually running HSFO that has the advantage that you can skip the primary crude intake, and that means that you don't get the straight run products that you don't want to oversupply. So you can skip that, and then you can go straight to an area where you can control the end product much better. And that means basically that HSFO and crude are competing more so than they have in the past. And what we show here is kind of EIA weekly data, and there's a data point basically for total intake. So that means intake of crude as well as intake of secondary feeds such as fuel oil or VGO. And we subtract that from the intake of crude. And so that residual here basically gives you an indication of how much secondary feedstock is being run in the US. And you can see that last year it was at record levels. So, you know, even though refinery runs were running very low, the intake of secondary feedstock was actually extremely high. So that's quite significant. So a lot of refiners actually are looking specifically for HSFO as a refinery feed. And we see that not only in the US, but also, for instance, you can make calculations in India that show that the implied uptick, just if you look at the shaded area there, implied uptick shows that, you know, there's quite a little bit of demand there for HSFO as a secondary feed. Now, a lot comes to the question about refining capacity, because when we look forward, this is going to be where the pressure points for HSFO come. And so, first of all, obviously demand is very weak right now, and you have a situation where oil demand is peaking much sooner than many had assumed. And so this has led to the shutdown of a lot of refining capacity. Some people are shutting down because they want to focus on biorefineries. Some people, with ESG being the key incentive in order to get public money. In some countries, you need to show that you're serious about emissions, and so there is divestment from Shell, from big integrated companies, going away from traditional refining. And then you have older refineries, for instance, those in Australia, where they simply cannot compete with the sleek new capacity coming on stream in China, for instance, or in the Middle East. And so that increases the competitive pressure. And because demand growth is not growing as fast as people thought, it basically means that all of a sudden the refining system looks like it has too much capacity and it needs to get thinner. So we have here on the left, you can see 2.5 million barrels per day of confirmed refinery shutdowns. And there's another 1.7 on the chopping block. And a lot of that is focused in Asia. Now, the fuel oil component of this, the fuel oil angle of this, is quite significant in the sense that the refining capacity getting shut down, as you can see in red there, has a much lower conversion to CDU capacity ratio. So that means basically that it's older capacity. It does not convert the fuel oil into clean products as much as the new capacity. And so this means that if you're depriving, if you're shutting down these less efficient refiners, you're also at the margin tightening the supply of fuel oil. And so that means that that's definitely something that will help keep HSFO cracks, for instance, strong. And moreover, the capacity you're adding has crazy conversion capacity ratios where you can basically convert most of your HSFO, most of your residue into clean products. So that's definitely a big factor that we are looking at. Now, if we look a little bit further, then what do we see in terms of refining capacity and consolidation? It's a relatively complex chart here, and I want to spend 1 minute on it just explaining it. First of all, it is cumulative, so it's showing you the change since 2014, since the beginning of 2014. And it just shows you how much capacity, refining capacity, so CDU capacity, has been added by region since then. And so you've got the declines, of course, that I talked about, the 2.5 million, but of course that pales because that's just offsetting some of the tremendous growth we've seen. So those are the stacked bars. And then we've got these yellow horizontal lines, and that's what we calculate would be the call on additions, so what you would need to add. And if you have a situation like we saw in 2014 to 2018, where the yellow bars are above what's actually coming online, then you have a situation where, because there's not enough capacity in coming on stream, new capacity, it means that the older stuff has to run higher. And that the only way to force that in the system is by increasing the price. So by giving margins, by giving refiners a better margin. And so when that happens, then you have great margin, but great margin environments inevitably lead to a lot of investment into new refining capacity. And that's what happened in this 2014 to 2018 phase. It was kind of a mini golden era for refining. And now when all of this new capacity comes on, and when peak demand is coming closer and closer, so ourselves, we used to think it was in 2035, then we were at 2030. Currently, we're at 2028, and some people in the industry are already saying that it's peaked. If you look at some guys out there say it peaked in 2019. So if that's the case, then you need a lot less refining capacity. So going forward, even on our numbers, assuming a peak of demand in 2028, we still see the need for another. You can see on the right there in the future, you can see how the yellow bars are much lower than what's actually coming on stream. That means that we need to consolidate or take off stream, shut down another 3 million barrels per day of refining capacity, which is a big number. Yeah, and so let me try and draw this all together so that we have some time also for the questions. Yeah, so the extreme highs for HSFO that we saw last year are over because fuel oil supplies are rebounding as crude intake recovers and more OPEC plus barrels return. That said, you cannot expect a return of fuel oil to the lows seen in November, or in fact, we expect them to still remain relatively strong. So not as strong as they were last year, but still quite strong. That's because the closure of older refineries is reducing fuel oil supply. And the new refining capacity that's coming on and taking that space is very good at killing fuel oil, essentially. Then we have a situation where bunker demand is holding up well. And we've got more ships coming on with scrubbers equipped, meaning that they will be processing HSFO rather than VLSFO. Whereas on the VLSFO side, right now it's easy to make because there's a lot of additional blend components available for refiners. But it also means that the secret ingredients have been figured out by now, and when a fuel is implemented, then the time for the strong premiums would have been last year when some guys didn't know how to make it yet, and those that had a first mover advantage could then profit from very strong cracks. That argument is over now. People know how to make it. It's relatively easy to make. There's several ways to make it. So it's not going to pop even when even if demand increases a little bit. But at the same time, remember the demand at the margin should actually be going down for VLSFO, and it might even be that VLSFO demand has already peaked, which is quite a thought, because simply we have more and more scrubbers in there, and then we also have a race now towards decarbonizing fuel. So every LNG ship that's out there is taking away some bunker demand, and that's also impacting, and at least in the future, that will be a bigger impact. So putting it all together, we would argue that the high 5 spread, so the premium of VLSFO over HSFO, we would expect that to average around $100 per ton over 2021, which is a lot lower than people would have been hoping, but it is at least higher than where it was last year. Yeah, and so that is the end of my presentation. So happy to take some questions. I think we have exactly 1 minute to take some questions. Patrick, I can't hear you.
Sorry, I was saying we can also leave those questions for the session afterwards.
That sounds like a great idea. Yeah.
Yeah. Okay, good. Let's do that. And then, well, thank you very much, by the way, for your excellent presentation.